I recently read The Intelligent Investor by Benjamin Graham. In the spring of 1720, Sir Isaac Newton owned England's hottest stock, the South Sea Company. Newton, sensing the stock market was overheating, sold his shares in the company, making a solid 100% profit. But a few months later, he got swept up in the market's wild enthusiasm and bought back in, but this time at a much higher price. The stock crashed, and Newton lost £20,000, which is equivalent to $3 million today. Newton may be the most intelligent human being to have ever lived, but he was far from an intelligent investor. He let the crowd's excitement override his own judgment and smarts, proving that intelligence alone does not make you a good investor. Intelligent investing is less about IQ and more about developing emotional discipline by taming overconfidence, preempting your reaction to events, and understanding Mr. Market. First, an intelligent investor must have confidence, but only if it's properly calibrated. Arguably, the best way to calibrate your confidence is to remember that every investment you buy has someone on the other side who's happy to sell it to you. So before you jump into a new investment, consider, what might the person or algorithm on the other side of this trade know that I don't? This question should prompt you to consider the possibility you might be missing something and create what Graham calls a margin of safety. A margin of safety is a buffer that protects you from substantial losses when things don't go as planned and gives you the best chance of making money in the long run. The first way to ensure a margin of safety is to avoid investing new money in a euphoric market. When investor optimism is through the roof, great companies get priced to perfection, meaning everything has to go right for their stocks to keep climbing, and it takes just a little misstep for them to tank. You want to buy new stocks when everyone's negative. A practical way to gauge the market mood is to check the CNN Fear and Greed Index before buying, or look up the latest AAII survey to see if bullishness is near a one-year high. It's counterintuitive, but the biggest risk of losing money comes when you and others feel great about your portfolio, while the lowest risk is when you and others feel miserable and are tempted to sell everything. Another way to create a margin of safety is by investing in financially sound companies, as their stock prices have little room to drop. Here are 6 signs of a financially rock-solid company. 1. Over $2 billion in annual revenue. 2. Current assets are at least double current liabilities. 3. Long-term debt is less than working capital, which is current assets minus current liabilities. 4. The company has positive earnings every year for the past decade. 5. Earnings per share growth is at least 33% over the last 10 years, which is about 3% annually. And 6. They have a price-to-earnings ratio less than 15. Quick side note here, Graham didn't live to see big tech companies like Apple with incredible pricing power and consistent double-digit growth, who have a reasonable price-to-earnings ratio of about 25. So take this last metric with a grain of salt. A company that checks all 6 boxes has reduced downside risk and should be one of the first stocks to recover after a recession. So before buying an individual stock, use an AI chatbot like ChatGPT to analyze the company's earnings reports and confirm it's close to meeting all 6 criteria. Now, the third and perhaps most effective way to create a margin of safety is diversification. One simple way to diversify is to split the money you plan to invest into 2 assets that have low correlation over any 1-year period, but have historically gone up over any 20-year period. A straightforward example is the total stock market index ETF paired with a long-term government bond ETF. These 2 will tend to act differently over most 1-year periods, but generally go up over the long haul. Diversification works as a margin of safety because as one asset drops, the other can hold steady or rise, thus cushioning your portfolio and giving you a chance to rebalance, like moving funds from bonds to stocks after a market crash. By avoiding overly optimistic markets, choosing to invest in healthy companies, and diversifying, you are becoming an intelligent investor. But if you can't predict how you'll react to an unexpected market downturn, you'll undo all your hard work. Every intelligent investor must be able to predict their reaction when things go wrong. Being down several $1,000s is hard for anyone to stomach, but giving into an overwhelming urge to sell and stop the bleeding is the biggest mistake a long-term investor can make. As author Jason Zweig says, the risk is not in our stocks, but in ourselves. Zweig, who wrote the brilliant commentary in The Intelligent Investor, insists that we all create an investment owner's contract with ourselves. An investment owner's contract looks like this. I, insert your name, as an investor committed to long-term wealth accumulation, understand the temptation to buy when markets rise and sell when they fall. I hereby declare that I will not let market trends or the actions of others dictate my financial decisions. I commit to holding the following ETFs or diversified portfolios, list them below, through at least month and year. This date should be a minimum of 10 years from the day you make the contract. Exceptions will only be made for urgent needs like a health emergency, job loss, or planned purchase, such as a home or tuition. By signing below, I affirm my intent to follow this contract and review it if I'm ever tempted to sell. Signed, your name. Type this contract into a Word document, print it, sign it, then use your phone to take a picture of it and store it in a folder you can easily find. Then, the next time you have the urge to sell, look at the photo of your signed investment owner's contract. Seeing the contract you committed to should stop you from doing something impulsive. Now, speaking of impulsivity, let's now talk about Mr. Market, a character that Graham created to help people better understand the market. Imagine you own a business and you have a quirky business partner named Mr. Market. Mr. Market wants to sell you his stake in the business. So every day, he swings by your office to tell you what he thinks his shares are worth. Mr. Market is moody, and on some days, he's overly optimistic and offers a sky-high price. But other days, he's in a funk and quotes you a bargain. His prices swing wildly based on his emotions and not on the actual value of the business. If you're smart, you don't let Mr. Market's ups and downs influence your thinking. You simply aim to understand the true value of your business and only take his offer when it's too good to pass up. Otherwise, you ignore the daily noise and just focus on keeping the business healthy. The risk that Mr. Market presents to every investor is that they persuade them to join their emotional roller coaster and impairs their judgment. One way to counteract Mr. Market's noise is to see the value of your stock portfolio like the price of your home. If you had no intention of selling your house in the next 5 years, would you call your real estate agent every morning to ask the value of your home? Of course not. So why do something similar with your stocks? Remember this analogy the next time you have the urge to check the price of your stocks in your phone, and let Mr. Market impair your judgment and get you to do something you might regret doing. In the end, when you block out the noise of Mr. Market, create a long-term investment contract with yourself, and make new investments with calibrated confidence and a healthy margin of safety, you, my friend, are an intelligent investor. That was the core message that I gathered from The Intelligent Investor by Benjamin Graham. This is a book with age-old wisdom, and it's been updated by Jason Zweig with excellent commentary. I highly recommend it. If you would like a one-page PDF summary of insights that I gathered from this book, just click the link below, and I'd be happy to email it to you. If you already subscribe to the free Productivity Game email newsletter, this PDF is sitting in your inbox. If you like this video, please share it. And as always, thanks for watching, and have yourself a productive week.